So consider a financial plan could be like an orchestral performance. And maybe at times all of the different sections of the orchestra. So we could say like maybe the wind section is insurance and the string section, maybe that could be your investments. Maybe another section is your estate planning. Maybe they all work beautifully together and you get the best, most harmonious piece of music out there. But what happens if you have an orchestra with a piccolo player that is wildly out of tune? Or you have a cello player who's decided to start a different movement than everybody else. That's sort of the dissonance that can happen when a plan can be built in fragments. So our goal today is to talk about how we're going to have that beautifully orchestrated piece of music.
So what I'm hearing, Melissa, is we need a conductor.
We are the conductors.
We really are. So let's get into it.
That sounds good. I was that piccolo player who's wildly out of tune, by the way. That's why I stopped playing professionally, actually. No joke. That's actually a thing that happened. I'm a good financial planner.
Yeah. Well, thank God you were that piccolo player. Welcome back to Money Talks Life Listens. I'm Joanne Kaban, your co-host and co-founder of Isle Wealth of Raymond James, and I'm joined here with my fabulous business partner, Melissa McGuire.
Hello.
Yeah, in today's episode, we're talking about what happens when you build your financial plan in fragments. So, Melissa, we often talk a lot about this in our meetings with clients. It's not that our clients don't have a plan or they don't have a bad plan. It's just they have a fragmented one. Mm-hmm. What do you mean by that?
Well, similar to what you just said, when we say fragmented, we don't mean like poor decisions. Mm-hmm. That's not what we're talking about. Most families that we work with have, they've done a lot of things right. They've invested, they've insured, they've done their estate documents. But the issue for that is maybe they were all done at different times, right? And that's a really important thing to note. And often when they were done at different times, they were done with different professionals, right? So no one then stepped back to look at all of them, like all of these different plans that people have made to see how they all work together.
Yeah, I often view kind of what we do, because we are holistic planners, as like the general practitioners of what we do, right? So we often, take triage of the clients that we have come in. And then depending on what we need or what the clients need, we send them to specialists, right? In that field, right? Yeah. So we'll send them to a lawyer for their estate documents. We'll send them to an accountant for more comprehensive tax planning solutions, right? But we're that driving force for our clients that kind of advocates to putting all of the pieces of the puzzle together, to make sure that everything is connected, right? And I think today we're going to talk a little bit about what happens when those pieces of the puzzles aren't connected.
Right.
And so I think that I'm really excited to kind of get into this more here.
I think yes. And the thing I like the best about what we do is when we are being the general practitioner and we are sending everything off to people off to the specialists for the different things, those specialists are then relaying back to us how it's going to work. And I find sometimes that doesn't happen when we think about general practitioners and specialists in terms of the medical field. Sometimes it feels like one hand doesn't talk to the other. When we are sending people off to the specialist, it is an expectation that we all are aligned. So when we're considering ourselves to be sort of the general practitioner of sort of the overall planning sort of thing, what do you see that makes families realize that things aren't actually connected?
Yeah, so often what we'll do is we'll come in and we'll get a tally of their entire inventory of what they've done. And sometimes when we're doing that, we'll find, a will that discuss setting up a trust. But then we'll also see kids be joint on every account, including property with their parents, right?
Right.
So right away there, we can identify that by them, the parents making their kids joint on everything, it's usually the verbatim we get is that they're trying to avoid probate.
Right.
But what happens is when everything is in joint name or has beneficiary designations, nothing actually flows through that will.
Right.
So they have a will that's set up to create a trust, but they actually have no assets actually flowing through the will that are actually going to form this trust, right? And so if they would have had, maybe that practitioner in the room with them, we maybe have been able to identify, hey, we've already kind of taken care of X, Y, and Z, that we don't necessarily need that trust, right? Or maybe
Right.
maybe we do in some situations. Or maybe instead of putting the kids on the property, it could have flown through the trust, right? So
Right.
there's different things that we would have been able to observe and see that would have eliminated maybe an extra step there for them.
Right.
So often what we'll see is just things are not set up structurally the way that they're maybe intended to.
Right. And sometimes that's intended the way they're intended to be now, where this we're talking about like fragmented plans being done at different times. And we might have like something that worked for people when they were in their early 30s. Now they might be in their late 50s. It doesn't make sense anymore.
And that's sometimes we even see with insurance, right? Like some people will be paying for, life insurance, and they're fully self-insured at that point. Like they don't really have debt. They have enough retirement income that they don't really, something were to happen to one of the spouses, that the other one could have continuity of their lifestyle. That may be paying a high premium for term life insurance. That's more of like the renter's life insurance. Eventually it will expire and you cannot renew it. Maybe it doesn't make sense to keep paying those premiums, right? So there's different things that we can kind of look at and say, like, is this necessary? Or maybe they do need extra insurance because they're going to have a huge tax bill at the end of their life. And their only way to solve for that tax bill is to sell the property, but yet they were hoping that the next generation would keep that property and live in it, right? So how are they going to come up with the money to pay for that tax bill, right? So there's all these different moving parts that we can have a conversation on and make sure that everybody is in the loop and that everything connects the dots there for them.
Exactly. Why do you think fragmented plans show up so often in really capable and organized families?
Yeah, I think a lot of people just want to be proactive and get things done. Like I know for myself, I get an email and I'm like, okay, I want to check that box. I get a lot of satisfaction from it. So, we'll have clients who leave their jobs and they have to make a really quick pension decision, right? And, instead of, taking the time to go chat it out with a planner to see how it fits into that big picture, they might just say, you know what? Yeah, I'm just going to keep the pension where it is now, because it's a lot more simple to deal with, than to maybe look at, does it make sense to roll into the pension plan at my new employer? Or should I look at maybe taking that out into a more self-directed account, right? It's just easier to check the box, get it done. We have children, so usually that sparks a question about, should I get more life insurance? And you say, okay, I got a child, I'm going to get more life insurance. But we don't necessarily understand how much insurance we actually are going to need. We say, let's just get some. It's better than nothing. We've kind of checked that box, right? So it's not that they're not doing a really good job at getting these things done. It's just maybe we're not looking at, okay, well, how does it connect? And what gap are we filling? Or maybe we're even getting too much of something. Right.
I guess further to that, I mean, think about the urgency of estate planning. Ever thinking about, very proactive driven people, sometimes, something might happen. Maybe it's an aging parent. Maybe it is a tragedy that's happened close to home. And it just automatically means get on it, get my own stuff sort of situated and ready to go. But that is something that needs to be revisited along the years. And so it might be something that's triggered it to talk about it right now. We're going to get this sorted while our kids are like 10 and 14 years old. And then, we move on. The kids are now, 35, and I don't know what my age gap was, but we're going to call 35 and 39 years old.
It's perfect.
Okay. And then we, things change, right? It's so much so of as you say, sometimes checking a box based off of a situation that has occurred, get something done, but maybe not see how it's still going to flow through the overall scenario to either, fill a gap or not inadvertently create a large gap.
Yeah, I think that's huge. And if you think about estate planning is a big one. I kind of alluded to the fact that some people might need insurance to cover taxes on their final estate. That's something that if we plan far enough in advance and it's not brought up due to a triggering event, like, wait a minute, I'm in my 80s and now I'm wondering, what's my tax situation going to be like at this point? And so many people, they just don't know to ask that question, right? And it's almost a little too late. It's not, I guess it's not too late, but it's going to be a lot harder to kind of get that insurance or fill that gap or that need than it would be if they were in their 40s.
Right.
Right. So that's where we can kind of come in and say, okay, have we thought about this? And it's funny because we'll often do a lot of these estate projections for people. And you start it and you look at how much your house is worth today, how much your savings are now, what you're putting away per month. And when you actually like inflate that, you know, with the rates of return, what everything might grow to by the time you're 90, that's a significant number, right?
Yep.
So it can sometimes, you know, be really shocking. We say, wow, this is the type of money I could leave to the next generation, and why planning is so important, right? So it's one of those things where I think just having those extra support and those extra people in the room, like an advisor, to prompt you on these questions can really help kind of, you know, put all those pieces of the puzzles together.
Exactly.
So what's the most common way, Melissa, that we actually see plans built in pieces?
Well, I mean, I think it happens gradually, right? Advisors change, life changes, priorities shift. So nothing feels broken at the moment. And so there's really not an urgency to review everything. Like I know when I say to somebody, you know, it's been really like quite some time since you reviewed your plan. We talked about this a few months ago. We talked about it a few months prior to that. And, you know, we haven't reviewed it. I think it's really time to take a look at it. And how many times people will say, oh, I'm really not that interested. Nothing's broken. Let's just keep going. And then we usually like, okay, that's great. Nothing's broken, but we still need to look it over.
Right.
Right. And I think it's if it's not broken, don't fix it mentality.
And sometimes when we ask those questions, we'll find out they've had another child. I'm just kidding. Right? That's usually that's a really big surprise. Usually we know leading up to that.
But maybe there's a new rental property that was purchased.
Exactly.
Right. And they're like, oh yeah, we forgot to tell you. I mean, that's few and far between, but or there's an inheritance that happened of a rental property or something, right?
Or maybe a promotion.
Yeah.
Right. And they're making that much more money and they're in the next tax bracket.
Exactly.
Right? So that changes our recommendations on saving towards retirement, you know, RRSPs, things like that.
Yeah. So I guess that's sort of the question. What life events do you see most often that trigger like the one-offs or the time to get going? It is stuff like that, promotions or death of somebody or you know.
Could be the death, you get a promotion, maybe you're moving, birth of a child, right? These are all major life changes that can impact your entire plan.
Okay, so let's talk about the breakdown. So, you know, we might have a perfectly fragmented plan that's working perfectly for a while. Where do you most often see a misalignment when the plans are fragmented?
Beneficiary designations is the biggest one that comes to mind. Like we'll often see that maybe in the will, it mentioned they wanted to leave, you know, 30% to each of their children, but in some of their investment accounts, they're only leaving it to one or two. Right. And then there's usually a story behind that says, well, you know, I wanted so-and-so to get a little bit of extra money because they were helping with this, or, you know, we were equalizing our kids by providing one with a down payment and the other one hasn't received that extra cash yet. Right. But yet it doesn't talk to each other. And when you actually do the math and the final tally, you know, one child might end up with more money than the others, even though that wasn't the intention. And it's just because things aren't talking to each other and aren't updated on the changes that were made. So we often talk a lot about insurance policies, right? And it's one of those things where you buy it, you commit to either owning it for the rest of your life, or you say, okay, I'm going to have it for 20 years and then look at renewal. Where do you see that being a problem if it's not revisited?
Yeah, insurance does come up a lot for us. And there's all sorts of things that can happen if the policies aren't revisited, right? Like, I mean, we could talk about your example just now of beneficiaries not being updated correctly, right? There might be a change in the family structure that needs that update happening, but it's been forgotten about on a side. There might be something as simple as somebody has made a decision to let go of a policy because they just decided it was too expensive, but forgot what it was for. And forgot to see the like inherently huge cost that would be in place if that insurance policy was no longer there, right? Those sometimes happen, and we're like sometimes shocked when people tell us that they've canceled things, and sometimes we need more.
Right.
Right? There's, as you say, there's different family dynamics that happen, different changes in a family that happen, different plans that have been made as you go along, and sometimes the insurance no longer is going to solve for the issue that we didn't know was there. Right? So.
Yeah, and it brings up to a personal story of mine recently is that like my husband had disability insurance that we were paying for. And so we had a policy that was specific to his job. And he's no longer doing that job anymore, right? So we're paying for this policy that actually no longer covers him for what we're paying for. Right? So it was one of those things, and I do this for a living. So I caught it within like a month.
Good for you.
I was like, wait a minute, we're still paying for this. And this was like his own occupation. And I'm sitting there thinking, okay, we should revisit this because he's in like a very different type of situation now. So we ended up reviewing it, and it didn't make sense to carry anymore, right? But if I didn't revisit it, we could have kept paying for something that wouldn't have even paid if he got disabled, right?
Exactly.
So
exactly.
it's just really prudent to review it on a regular basis.
Exactly. Yep. Okay, so this is one for you specifically. Let's talk about cross-border planning. How does cross-border planning complicate things even more?
Yeah, when you're dealing with things on both sides of the border, one change could cause a whole ripple effect, right? You're dealing with two different tax systems, the IRS, the CRA. You're dealing with different ways that accounts pay out to beneficiaries. Like in the US, beneficiary payouts are, I find, a lot more flexible than what they are in Canada. Like we can pay out, like for a registered plan, for example, in Canada, it gets paid out to the beneficiary on passing, right? Like immediately, all as a lump sum. In, the States, like for an IRA, for example, it can be paid out over 10 years. So you can actually like kind of space out that taxable event in a much more efficient manner. Whereas here in Canada, we have to kind of plan for when that final spouse passes away. Because if there's registered retirement savings plans or RIFs left behind, often that's going to push clients into the highest tax bracket that they normally weren't in, right? So there's a lot more planning that has to be done when we're talking about dual taxation. There's also dual wills that sometimes need to come into play, right? So I guess the key here is that you need professional advice.
So what assumptions do you see that people make that gets them into trouble cross-border wise?
I think they just assume that, I'm gone. Sometimes I hear this, well, I'm going to be gone. My kids will deal with it. It can become, like the IRS is very punitive. Like they will charge a lot of fees if things aren't done properly. So it's one of those things where you just don't know what you don't know. So it just it's just best to make sure that everything is laid out in a certain way. Right.
And if you think that it's the same,
it's not.
It's not. Yeah.
So let's talk about something that actually happens, like illness, incapacity, or death. What's hardest for families when plans are fragmented?
Well, the confusion is the hardest part. Actually, I have a story to this that I heard once of a family member that had children, and in terms of what they wanted for their care until they passed away, and then after they passed away, like the sequence of events that they wanted to have happen and how they wanted it to go, they told each of their 5 children something different. So that, to me, that is the definition of a fragmented plan. So not sure, I don't know much about the whole situation. I just know about the confusion that resulted and the confusion and the conflict that happened as a result. Now, fortunately, this family, from what I had heard, all 5 of them, for whatever reason, sat down and started talking. And that's where they all learned they've been told something different.
Wow.
So the confusion is, incredible. So everyone assumes that either they know what to do or somebody else knows what to do, right? And then because they're already under emotional stress when something major happens, it is so easy, of course, for things to completely fall apart, and the discord and the conflict and all of that sort of to all that stuff to come out, all those really big emotions to come out when you're trying just to piece all of these fragments together.
Yeah, I mean, we've had a client that had like worked at what, like 15 financial institutions.
Yeah.
I could not imagine being those kids, like having to go to 15 different banks to have to, do all the estate planning process at each one. And some
Yeah.
of these, and most of these were virtual,
Right.
right? And all had different things going on in each one, and there was different taxable events and things like that when we first met this individual.
Yeah. Different provinces and everything. So,
It's just so much that they would have had to work through if
Yeah.
they didn't simplify things,
Yeah.
right? And a lot of that, why was it that they went to all these different institutions? Do you remember what the main reason was?
Something to do with insurance.
Exactly. But what they didn't know is that we were able at Raymond James to actually hold all of those GICs in one
Yeah.
account that would be able to be CDIC insured,
Yeah. Yeah.
but make it more simple for clients, right?
Exactly. Yeah. Why do you think that when, in doing things like that, that the emotional cost is actually often larger than the financial cost?
I think because, in this situation, as an example, if I was that child, I'd probably go to one, maybe two financial institutions. But by the third, I'm like, oh my gosh, this is so much work. I don't have time to go through this process. And it takes a toll on you. I just want to grieve my parent. I don't want to be dealing with all of this financial stuff, right? It's just such a burden. Like, we had a trust officer on the episode, on one of our episodes, and often people think that this is a gift being an executor, but it's like a part-time job you never asked for.
And yeah, exactly. And I think about it from the perspective of my story, that if those kids hadn't thought to get together and talk to each other, then they needed each other for support afterward, right? And if they hadn't thought to get together prior to, they wouldn't have been there for each other, because everybody was arguing by the time they all talked to each other. I'm quite shocked from the story that I heard that the kids actually managed to get together and have a conversation and figure it all out.
So when you actually talk about integrating a plan, Melissa, what does that look like?
I would say it means like an overall review. Step back and take a look at all the different aspects and see how the puzzles fit together. My earlier sort of analogy of an orchestra, see how each part of the orchestra plays together, and make sure not one part is not playing a different piece, or somebody's not completely out of tune or whatever. Just make sure it's a harmonized piece of music.
Right. And that's where we can come in to help with that, because we have the ability to kind of organize all those pieces for our clients. And so, you don't have to do it alone.
Exactly.
We're here to help.
Yeah. And do you think that in talking about integration, for us, often people think that means having to do everything all over again, but it doesn't. What do you find reassures clients when they hear that integration doesn't mean starting over?
Yeah, I just think it's hearing that validation from somebody else that, look, maybe it's just a tweak of a beneficiary designation on one account.
Right.
That's going to equalize all the kids, right? Like, we're going to be there to say, hey, if we don't name a beneficiary here, here's what this means. Right? Like, we can just flow chart it out. That's like, Melissa's like the queen of flow charts in our office. So that is so helpful to have that visual for a lot of clients for what you do, is to be able to outline, okay, this is exactly where things are going to go. And then it just brings clarity.
Well, exactly. And I think we talked about it earlier about how like some very capable families just need to get things done. And they're done in a way that's important to them. And to find out sometimes in the end that it's just a tweak that's needed to make sure that all aspects talk to each other in the plan. I think that says a lot for people's confidence in themselves as well.
Huge. Love that. So for any of our listeners out there that think this might apply to their situation, that they've got fragments, what's the first step?
I'd say ask yourself who's actually looking at the whole picture. So, and if you don't know the answer, usually it's time to take a pause and review.
So as we kind of talked about throughout this episode, is that most families don't actually need a new plan. They just need someone to help them fit the pieces together.
Exactly. Thanks so much for watching and listening to this latest episode of Money Talks Life Listens.
For all things Isle Wealth, please check out our website, islewealth.ca. Follow us on Spotify, subscribe on YouTube, and check out our new Instagram page.
Thanks so much for listening and watching.
Bye for now.
Corporate disclaimer. This podcast has been prepared by and with expressed opinions of Joanne Kaban and Melissa McGuire, and are not necessarily the opinions of Raymond James Ltd, RJL. Statistics, data, and other information presented are from sources RJL believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for informational purposes only and should not be construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making an investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions and/or issues in these areas, please consult a legal, tax, and/or accounting advisor. RJL is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd. advisors may only conduct business with residents of the states and/or jurisdictions in which they are properly registered. Raymond James USA Limited is a member of FINRA and SIPC. We hope you enjoyed the podcast, and for more information, please visit islewealth.ca.